Good turnaround Tuesday, Warriors. Hiya, Bran. Yes, I'll lead you from my bunker. Hi, Glenn. Sinatra. AJ. Mike, how are you? Hi, Ryan. Patrick. All right. So turnaround Tuesday here. Here's a candidate. And not just because it's Tuesday, but it got within, I think, 10 pips or 5 pips of 78.6 back on Euro. Is it worth a stab, Ryan?
you keep trying to tempt me into longs, mate.
Yeah. Well, I mean, there's finally a reason,
Yeah.
So I don't know. Let me look at your
typical
favorite
big
chart.
figure. Yeah, typical big figure action down there. 106 held, not tempting enough for me in this current environment at the moment.
All right.
Especially with Powell later on today, which I think is the probably the big risk event of the week, maybe.
What do you think? Is he going to affirm what the data has said, or is he going to kind of brush that aside and we're still on course to ease this year? Or
that's the big question, isn't it?
Yeah.
We've had the inflation data, we've had the PPI data. The last FOMC and appearance was him saying that he still thinks it's appropriate to cut rates sometime this year. And then you get this data and the market goes, well, you keep telling us it's appropriate to cut and we're getting higher inflation, better jobs, higher PPI, and all the data keeps pointing north. So how are you going to cut? And so the market gets all hawkish again. Powell's going to pop up. He's either going to not acknowledge it and say, well, actually, yeah, this is a bit more sticky than we thought, and we're ready to respond. And then he could counter that also by saying, but even so, we're still ready to cut rates if necessary. So it all depends on what balance he strikes. Either way, the market's going to move. It's either going to carry on getting all hawkish because that's the way it's going anyway, or it's going to try to reverse it a bit because Powell's pushed against it. So, yeah, one way or another, I think we're getting a move if the subject's touched upon. And if it's not touched upon, the market's probably going to carry on as it is and yields higher and dollar higher.
Okay, so this breakout still in force here at 478 on the 2-year. Not that far away. 30 bips away from the October lows.
Yeah,
what do you think?
And well above the where the dots are going, aren't they?
Yeah.
So this is always for those traders who don't trade bonds or don't understand bonds and their effect or everything. You can use this as a perfect example of where the market thinks rates are going compared to where the Feds think they're going or predict they're going. So if the market's getting too hawkish or too bearish.
Yeah, almost a full point from February.
Yeah, it's a lot, isn't it?
10 to 5. Yeah. Okay. K-Man, any reaction to? I know you follow the twos.
Hey, K-Man is not here.
Okay.
Yeah, he's got an appointment, I think. But guess who's here, Dale? And good morning. Grega is here. That's right.
So actually, Grega was looking for one more pop in rates the last time he was here. So I'm glad he's here. And what do you think of my memory?
Well, rates made a very impressive moves so far. So I'm not really sure if we will see any reversals anytime soon. Dollar is also getting strong. And now when we are seeing finally stocks also turning to the downside, I just think that maybe in the short term, the rates will stick to current levels or even higher.
Okay, so what was it that changed your count?
Well, the big picture is still actually the same. It's just maybe this because later they will decide for potential cuts. More longer the current trends will last. So in my opinion, I still think that dollar will eventually turn down this year. Just we have to respect the current cycle that we are in, and could easily even extend to 108, 109 if we start breaking below above 107 on dollar index.
Okay, so I'll give you a picture speaks 1,000 words. That you've got the screen.
Yeah. So actually, we can, since I mentioned S&P 500 here earlier, well, as you know, dollar has been doing very well despite stocks that have been recently trading to the upside since start of the year. But now, when stocks coming lower, I just think that maybe this temporary risk of course, can keep dollar still in this bullish phase. But correlations were not perfect, so I would not be surprised even if in this current environment they will change a bit. You may see maybe a strong move down on stocks, but maybe still dollar will stay somehow sideways. But looking at the S&P 500 here, I just think that we triggered this new corrective setback. So the important is to understand that this is a correction. We had some gap here that goes back to February 21st. So I think that this around 5,000, slightly lower, I think it's a very interesting support for this wave 4. Now, sometimes wave 4 can be very similar in distance, in time. Yes, compared to wave 2. So as you can see, there's still plenty of time actually for this correction to keep unfolding. So I just think that maybe we will stay in this corrective sideways price action for maybe for even a month or two from now. So, but overall, I just think that there's still an uptrend, and that's only the pause within this ongoing strength. But as you know, with these tensions in the Middle East, I still think that the best trends are on metals. Crude oil is also looking good. Now, if we firstly take a look on maybe this one, gold miners, as you can see, I'm tracking a very big triangle here, potentially trying to break out. So I'm definitely expecting more upside on gold. Eventually, if we take a look here, okay, there's a very nice and strong extended lag. So last time when we discussed Dale, as you know, we've been talking about potential wedge formation. But obviously, because of this very strong flow over here above 2,300, I just think that that's an impulse because that's a pretty extended lag. Strong extension, usually within 5-wave impulse represents wave 3. So more upside, in my opinion, can occur after pullback in a wave 4. Also, let's say that maybe if you look at some very big picture here, at the bottom here, I have the Fed funds rates. And always when they were on the top, and then this cycle changed and came to the downside when they started cutting rates, gold made a very nice, impressive run to the upside. It's been the case here, 2008, as you know, then 2019. And now again, if we are going to see this new change in cycle, and they're really starting to cut rates by the end of the year, then I think that obviously gold, which is already very strong, can have much more upside potential, not to mention other risk that is on the table, like inflation and this on the Middle East. So in my opinion, this fifth wave has a plenty of room for more upside, and there can be opportunities within this trend. Now, if we scale down to the smaller time frame, you can see that I'm observing this impulsive uptrend here, okay, in a higher degree wave 3 that I showed you earlier on the daily chart. And even wave 3 should be structured by 5 subwaves, okay? So I'm looking here now for a temporary pause for a wave 4. I think that it's a very nice support around 2,300 on this dip, and I will potentially be looking for buying opportunities here in that range, maybe $50, $40 range here.
So it seems like S&Ps and gold are in sync.
You think?
You're looking for a 4 in S&Ps and then new highs, and you're looking for a 4 in gold and then new highs.
Yeah, but that's more like actually both are in uptrend for this year. We cannot ignore that. But I still think that whatever is happening right now, the world, I just think that maybe safer game plan is looking for opportunities on metals and gold rather than maybe on the stock market. But of course, we'll see how this will how these levels will play out slightly lower here, around 5,000 here on gold.
They've both been going up together, haven't they?
Excuse me?
They both have been going up together, basically, right?
Basically, yes.
all one market. That, you know, the only thing out of sync has been how those markets have ignored a strong dollar, both S&Ps and gold.
Yeah, so imagine now if dollar comes down suddenly. I'm not really sure what metals can do then.
Yeah.
But I mean, they're certainly in uptrend. Also, maybe it's worth to look at gold-silver ratio. Let me check where I have it. I think I have it somewhere here. Okay, so gold-silver ratio, as you can see, that's actually 1.5 year range. Okay, now you are at the lower side of this range. So maybe the gold, since, as you know, this gold-silver ratio came to the lower side of this range, maybe gold will outperform silver, and that's why we'll pay attention to to gold in the next few days if we see that pullback deeper one for a wave 4.
Okay, nice looks.
So, yeah.
Anything else?
Actually, maybe since I mentioned earlier, crude oil.
And Greg, just since we do have to cover it today, and so if you can give us a view after crude, let's just take a look at what you're saying about the Canadian, because we will have Canadian CPI in about 20 minutes.
Yeah, just a second. Hey, Vid, that's my son, came from school. Okay, so firstly on crude oil, where we are seeing a very nice consolidation here. I just think I cannot imagine who would sell crude oil based on everything what is going on. We will either stay sideways if everything will come down a little bit, or maybe just see another push higher here. I assume that's a very nice, healthy consolidation. As you know, a lot of commodities are trading quite aggressively higher for the last few weeks. So I think that even crude oil at some point could see another push higher, maybe already by the end of this week. So I'm bullish here on crude oil, at least for the short term. Since I mentioned dollar CAD, right?
Yes.
So dollar CAD, I'm observing the very big, I mean, I don't really like this price action so far because we are still in the range. Now currently trading at the upper side of this range. We are approaching this potential trendline resistance. And if we are really going to structure a triangle here, then we need 5 subwaves. A, B, C, D are already happening. Wave E is still missing. So there's a risk that maybe there will be some higher degree retracements. Of course, longer, let's say for the next year or so, of course, wave C can still or should still pass these highs from 2022, but you definitely want to see some aggressive daily breakout above that swing high that goes back to November 2023. So until then, I just think that maybe this big range will stay, big levels will stay in play.
All right. Well, I appreciate that, Greg. I appreciate your looks ahead of the Canadian data. You know, also daily sentiment index is reaching a little extreme, and that's one of the things that that kind of worries me as well. So so really appreciate that. And guys, if you don't know this already, you know, we cover 30 different instruments on ForexAnalytix, and Greg, he you know, when he gets an opportunity, he pops in our chat rooms, but also he posts all of his counts, his analysis on, you know, 30 different instruments, not just currencies. There's, you know, the DAX and the 10-year and, you know, S&P, gold, Bitcoin, everything. So so Greg, we appreciate you stopping by here. It's not every day we get you.
Yeah, I will try to do my best to be here more often.
Yeah, thank you. So, you know, let's talk a little bit about, you know, Dale, we've seen a breakdown in equities. And matter of fact, I'm going to talk about a few currencies here too, and bring Ryan into the conversation as well. But first, I want to talk about, you know, the equity markets. We saw the S&P finally break this 5110. Now, the reason why this 5110 level was so big, in my opinion, not because it was horizontal support, it's because we've finally created a lower high, or excuse me, a lower low from when we hit a new high, a new trend high. Once you hit a new trend high and you reverse below that previous low, that's a shift in trend, not we haven't, I mean, you could argue that we have a shift in trend that is now lower, but I would argue that we've broken the market, broken the uptrend near term. My skepticism was really, you know, not so much the S&P, but it was the NASDAQ. But what we've seen is the NASDAQ 100 has broken horizontal support. Finally, Dow's broken down. You know, obviously futures are up this morning, you know, following all these bank earnings that we've seen. But Russell 2000 also, you know, it's just getting clobbered. Another failure, big failure in the Russell. So you're seeing equities really start to roll over. Even, and I want to show you guys, you know, the European markets, and you got the DAX, which was trying to do a, you know, well, it still is. I guess we could argue that it's still trying to do some sort of bull flag, but we've broken an ascending trend line. You know, the markets do look vulnerable, and I know they're up this morning, and it's always hard to say that when you're like, well, look, you know, stocks have recovered, you know, are recovering this morning. We got some earnings. Nothing looks bad. I don't know if you guys saw all the earnings out overnight. Here's our chat room. So Gav gave a good update on Bank of America, J&J, Bank of Bank of New York, excuse me, Mellon, UNH. You know, all decent earnings this morning. I think there was I think Morgan Stanley just reported. I have to go back and take a look this morning. Anyway, earnings don't look horrible. So stocks are recovering a little bit. Daily sentiment index is getting a little bit extreme on some things. But what do you make of all this, Dale? I mean, S&P and
Well, what have
stocks,
I been saying?
They look a little vulnerable, right?
What have I been saying?
I don't know.
You don't? Okay. Well, we had the 2-week reversal the week before last and follow through last week. And I put out sells at 52 to 52.20 with stops over the high of the move.
You
I
know,
think that.
oh, go ahead. Go ahead.
Ahead.
No, I was going to say, you know what? I joined you in the S&P last week as well on a pattern in play here. You know, for short. I think they look vulnerable, but it was like this NASDAQ break yesterday was the one thing that it was like we were missing it, right? And so now we're seeing the markets correct a little bit, especially, you know, the NASDAQ has been just consolidating for a month, and we're finally seeing it break a little bit. But, you know, you have all of these moves that are starting to take place. And now you have, you know, a geopolitical reason why things might get a little, you know, dicey. I just saw a headline, and you guys can probably see it here. This is on CNBC. Israel's war cabinet is locked between restraint and revenge. You know, there's a lot of people that believe that Israel is going to retaliate, and they're not going to want to look weak, and they're going to want to, you know, they are going to want to retaliate. And I think that is like a, you know, that is a pretty common belief. What say you?
No doubt.
Oh, so you're in that camp. All right. So that means we should all be on guard. And, you know, that goes back to what Greg was saying about gold. You know, gold, very, very minor pullback in this channel, and you can see the dips are being bought. And he was just mentioning, you know, looking for a dip back down towards the support, probably a good level to be on the long side in this very, very bullish trend. So really, I'm in the sell rallies camp, and I think the market is, you know, we're seeing a recovery here, which also means at the same time that you got to be in the buy dollar on a dip camp. And right now, the dollar index, we have broken the 78% retracement. We have almost reached 106.50. And Dale, I know we've talked about 106, 106.50 for ages, and we're here, but I'm not willing to step in front of the dollar. I actually think that the dollar looks like we could actually break out. So, you know, to give you a couple reasons why the dollar breakout could continue at this point: risk aversion and U.S. exceptionalism. You know, we have a little bit of little salt and pepper between both with the dollar, and that's keeping the dollar very well bid. I say exceptionalism because the data is, continues to be, very good, at least at this point. And then you got yields that continue to rally. So, the dollar is pretty well supported at this point. We have to get really below 105 for me to say otherwise at this stage in of the game. Ryan, we had jobs out of the UK, and what did you make out of the UK jobs data this morning? Because that was really early for you this morning.
Yeah, 6 of one, half a dozen of the other. We had softer employment, higher unemployment rate, job losses, employment down 150 odd thousand, but then we had sticky wages. So wages were pretty much unchanged on the month. We're expected to come down a bit more, and they didn't. So, yeah, a bit of a neutral number for the quid and rate expectations. We now move on to the CPI tomorrow, which will probably be another big piece of the jigsaw. But it still keeps the Bank of England between a rock and a hard place on what to do with rates. So that data didn't give us any clues or give them any clues either.
Well, the good news is we got some more data from the UK coming up this week.
Yes, CPI tomorrow. Yeah,
we got CPI tomorrow. So let me ask you, where are you at with sterling? I actually think, obviously you can see by the looks of it, it's a bearish breakdown. I'm short some. I've been short some since yesterday. I'm looking to actually add to my position as long as we stay below 125.50. I really, which is 100 pips from here. I still plan on being on the short side. How are you reading sterling right now?
I'm not reading much into the cable move because it's it's all about the dollar. As I mentioned on a tweet this morning, if you've got two central banks in cable, the Fed and the BOE, and neither of them know what they're going to do with rates, so you're probably better off playing it against the crosses, euro versus sterling, where we know what the ECB is doing, and it's just the BOE that doesn't know what it's doing. But for cable, 124.5 is an old pivot line that we've seen many times before, and we've been mooching around it this morning. Either side of that, it's 124, 125. So that's your range. If we're breaking 124, we're going to be heading lower. Break 125, and we're going to undo some of this down move that we've seen.
So, last night we were looking for the 124.14 level, which is 127% extension, which was hit. I mean, we came within pips of it on the underside of it, which really, you can see as we probe that 127% level, and you can see the reversal there. That really reinforces what you just said. I mean, below 124, I've got to imagine there are stops in sterling. But looking at today, I don't foresee us getting down there unless we see some, massive reversal in equities. I mean, because I say a reversal, I mean lower, which could be the case. The reason why I say that is because we don't really have any U.S. data that we're going to hang our hat on today. I don't think we got. Well, no, actually, let me take that back. We got Powell. We got Powell.
Yeah, that's what I said at the start.
As you said,
it's probably the biggest event. It's probably the biggest risk event for central banks we've got this week.
So I know you mentioned it to Dale. In today, you got Powell at this. He's at it's a fireside chat if my memory serves me correctly.
Yeah, with Macklem.
And with Macklem, okay. And so, do you think he's got to tread water a little carefully ahead of the just knowing what's happening around the world? Yeah.
Yeah, it's a damned if you do, damned if you don't moment. If he doesn't mention anything to do with what's gone on, the market's going to go, well, he's all right with that, and dollar rips. If he does mention it and says, yeah, we're actually a bit worried about it now, dollar rips. If he says, actually, no, we're not that concerned about it, we still think we're going to cut, then the dollar's going to undo a lot of this work. But I don't think it's going to believe him for too long because he keeps saying the same thing. The market keeps seeing stronger data. At some point, the market's it's like crying wolf. At some point, the market's going to call his bluff and say, "We don't believe you. We don't believe you're still going to cut rates when we're going to take the dollar higher and yields higher." So when you look at it on balance from a trading perspective, there's two reasons why the dollar might go higher from Powell, and one reason why it might not. And the reason why it might not last anyway. So that's 2.5 reasons why the dollar may move higher after Powell, whatever happens tonight.
All right. Well, interesting. You know,
What
we got
time
about
is he
5.
going to be on?
He's on at 10:15, which my time, which would be your time too, Dale,
Yeah,
which
we're
would be
same time.
1:15, 1:15 Eastern.
Okay, thank
Couple
you.
things that are happening, and then we're going to go into the Canadian CPI. I just want everybody to know, if you follow the Kiwi's just been getting bludgeoned. It's just, the thing's just so heavy. It's like we trade below 60 cents, then below 59 cents. Now we're on our way to well, the next stop's going to be 58.50, and then next thing, this thing's just trading super heavy. We got CPI tonight, which will be late this afternoon for me, but it'll be tomorrow morning in New Zealand. We got CPI coming out. Then we have UK CPI. A lot of inflation data today from around the globe, but that's all following as we just were talking about. Powell, Macklem, Barkin speaking just before that. Williams is speaking. Bailey's speaking this morning. So there's a lot of central banker shit talking happening. So keep your head on a swivel. Watch your six. You got headline landmines all over the place. One of the other things I wanted to point out before we get into CPI, I want to take you over, guys, over to the dollar MEX. The reason why this one is so important is we've had a false breakdown in the dollar MEX. We're challenging channel resistance in the 50 DMA. I had 3 trades, obviously, for the week ahead video. If you guys don't know that, on the week ahead video, I give you my 3 trades of the week, and then I review last week's trade. So it's a little bit of, hey, this is what I said last week. Let's take a look at them. And these are the setups from this week. So dollar MEX, looking for a big reversal here. And we're above the 50 DMA, and we're at channel resistance. If stocks continue to look weak, we will trade up to the 200 DMA. We're going to continue to squeeze all these, carry trades. Also, Dale, you're going to like this one. On Monday morning, or on over the weekend, I'm like, dude, as soon as you get in front of the computer on Sunday, copper, decent short here, 161% extension, horizontal resistance, just it's good risk management. I mean, you have you keep your stops above 440, and you just look for a move back down to 4. So I mean, it's taking place. And it's on the move. So keep those
it's good or bad from there, and you know where that is. So
well, that's like any trade, right? We can't I get plenty of trades wrong, but what you can do as a trader is risk manage, and that's what our predominant job is. And so if you don't know how to do that, make sure you jump in the chat room, jump in with us, talk about the markets. Get some coaching lessons from Ryan or K-Man or somebody here in our staff, because that's really what everybody should be working on. All right, let's take a look at the dollar Canadian as we're heading into this Canadian data. I do think that intraday relative strength is divergence. We're heading up to the 88% retracement. I'm buying dips, but if we get some strong Canadian data today, I'd let us slip all the way below 137 as a result. So with ForexAnalytix, we're going to pull up the data flash, and here we go. There we go. All right. And let's pull up the dollar Canadian. Any last minute things here, Dale? You got less than a minute. Any last minute thoughts?
No, I'm with you, Blake, except for scalps on the short side of the dollar. That's it. And I think today might be the day where we get a little pop.
Yeah, maybe we get a little bit of a pullback. And I know it's somebody was Salem was asking, where's Nick? He's loading the bag. Nick will probably be joining us, I would assume, tomorrow, maybe towards the end of the week. I'll be stepping away from the desk at the end of the week, so Nick may jump in and join you guys here on the F.A.C.E show. He's been putting together a lot of great videos. If you guys haven't checked him out at Trading Analytics, you should. All right, so Ryan, any last minute thoughts here? Oh, never mind.
No, 1 second.
All right. CPI a little weaker. Oh, damn. Okay.
Weak housing week as well. US housing week as well.
Yeah, I mean, you know, my assumption is that sucks. It's gonna housing starts being weak is not a good thing. And I'm going to tell you guys that right now is we are very low in supply here in the US. That's going to keep house prices very sticky. That's going to keep inflation pretty sticky. You know, it's not going to help the situation. And if you think, you know, oh, that's US dollar negative, it's not. It's actually dollar positive. The housing data actually needs to improve. You know, and that's not, this is not good in my opinion from an inflation point of view. Anyway, weak Canadian CPI data. You got the dollar Canadian spiking up. One of the other currencies I'd be watching right now is the Euro Canadian. And the reason why I would be doing that, not just because I'm long, because we got, you know, really nice technical development shaping up. You can obviously see it. I don't have to, you know, spell it out for you exactly what we're looking at here. So keep your eye on the Euro Canadian, especially if the Euro stays stable versus any other currencies. You know, I think the Euro is really stuck in a 105 to 110 range. So, you know, maybe 105 to 108. So I don't think there's a lot of downside in the Euro, which means that it could play it to the long side against a lot of currencies that are underperforming, like the Canadian. So with that being said, guys, make sure you, if you want to chat with, you know, Ryan, K-Man, myself, throughout the course of the day, and, you know, other people from the ForexAnalytix crew, jump into, you know, take a trial of ForexAnalytix. It's only $1 for 10 days. We probably have one of the busiest and most active trading communities. Check out our one-on-one mentoring and obviously the trader funding program. If you guys want to get, what's interesting is we've seen a big tick up in trader funding because people know that we've got higher volatility. So if you want access to larger amounts of capital, make sure you tap on this trader funding program, check out what it's all about. It's a good way to get inside of ForexAnalytix at the same time. All right, Dale, I'm going to pass it over to you. You guys have a great trading day. And what?
Stover.
Oh, is he? Do I need to grab him?
Yeah.
You know, hey, by the way, I keep asking, and today during our team meeting, Dale, we're gonna ask, and we're gonna nail Steve down for that. Let's see if we can do that. Let me bring Chris over. Hey, Dale, you remember the old game, Red Rover, bring Chris Dover on over?
Yeah, that's a good one.
Look, I've got a few of those too. All right, he's over. So
all right.
Red Rover, Chris Dover, welcome to the F.A.C.E show. All right, you guys have a great interview, and welcome back, Devil Dog.
Yet. Good morning, sir.
Yet.
Hey, Chris. How are you,
Dale?
buddy?
How are you, sir? Great. How's everything?
What's on the menu?
Well, I actually put together a bit of a presentation at least today, if you're interested.
Yeah, sure.
I came prepared.
A PowerPoint you want to show?
Yeah, I'll blast through that real quick and give my case, and then we'll take a look at a few charts and then go destroy this trading day.
Okay, sounds like a plan.
All right, let me find it real quick. That's the one. Make sure we're all seeing it.
Wow. It's psychedelic, man.
Stringy, man. Lots of mushrooms in this chart and stuff, probably.
Yeah, you're tracking everything. So is this like a relative strength type chart?
Yeah. So this is since the beginning of 2024. You know, we can certainly go back to whatever resolution we want, but just I want to start this all off with like just how impressive cocoa relative to, let's say, the NASDAQ has been. 157% on cocoa, 72% on NVIDIA, Dogecoin at 67%.
Isn't that amazing?
Yeah,
that was a joke. I thought Doge turned out
I mean, it still is. It's just the people that trade it don't really care if it is or not, I suppose.
What's the use? You carry it when you take your dog for a walk?
No. Much like the way I trade cocoa to make money.
Okay.
It's just
another pink sheet.
I honestly, really, that's what it is. You know, there is a bit of a, you know, and I'm not a, you know, super proponent of, like, I'm not here to pump Doge or Cocoa or any of those. Just it's just a way where people are just putting their money in to make money.
Yeah.
But yeah, pink sheets is a great way to. So let me get going here. Let me start out from the beginning, and whoops, everything went just. There we go. That's the one. Okay, so what I'm going to be talking about today is getting into the right game and playing the right game and staying in the game. How important it is instead of just overall. That's what my thing is. So it's called table selection in poker. Just finding the hot table, finding the right table, being there, being diversified about a bunch of different strategies. If you're just a, you know, simple one, this only works on this asset in this time frame, well, you got to wait every whatever 5-10 years for that one setup to work for you, and that's great. It works really good over time if you can outlive it. But if you can diversify strategies as well as the asset you're trading, you can get a little bit more out of it, and, you know, live day to
What's
day a little bit
your
better.
best strategy? I'm pretty good at finding the right table and then entries. What's your psychology and method for staying in the game? I think a
That's
lot of
actually,
people have that problem.
absolutely. It's I actually have moved into the position of, I am more than happy to stay longer and give it back, give some back, because I know I will. We all know we will. We know we also, the second we've gone, you know, we go from like 7 losers, 10 losers in a row, and you finally get that one and you get a winner, and you're just think to yourself, okay, great, I'm out now. You know, the more time you spend doing the statistical work on it, for me, and stop just getting caught up into the day-to-day, week-to-week returns, has been the thing that helped me. And I'm not saying it's for everybody, of course, but the more I focus on that, the more I can let those things go and realize that one of them, 2 of them, 4 of them are going to really do all the work. And that's just going to take all of my attention away from every loser that every time I've tried to catch cotton or sugar for the last 6 months has been far overran by the times that I've just sat in cocoa and watched it run. So once you get on the other side, it's easier.
How about a trailing stop is what I use to keep me in a trade. I may lose my discipline and say, I'm just going to book it. But a trailing stop is going to keep you in the market longer. Instead of making a decision, you have something there. So
yeah, absolutely.
The market makes a decision.
Yeah,
right?
a statistical tool like an ATR or a moving average or a percent trail or any of those sort of things that just absolutely. I tend to use pretty much by the time something gets flat, I will end up, let's say you go for a big 5% spike, 10% spike, and it just goes. And then we all know that it is going to go sideways for a little bit of time. And then just before it's about to take off again, it's probably going to go and get that last little group of people who are just hanging out for the next one. And then it goes, and then, you know, you get your stop out, and then it turns around and takes off again, which is fine, because your same system that got you in should get you back in again if it is another breakout trend. That
I want to acknowledge, Chris, last time you were here, and I talked to guests every 3 to 4 months, you were very bullish the stock market and S&Ps, and that was prior to the melt-up. So were you able to milk that trade?
Yeah, for sure. We've been and in fact, we're not looking to lighten it up too much here
now?
either.
Okay,
yeah.
I want to acknowledge you were, that's what you featured last time you were here.
Yeah, that was the hot move.
Yeah.
Appreciate that.
Some hosts won't remember. Okay,
Yeah.
so
Yeah.
I like to acknowledge when people that come here, have conviction about something, and they're right. And I also bring it up if they weren't, which happens
Yeah.
to everybody. So
Of course.
anyway, great call, great forecast, and you're still long, so that's interesting. All right, go ahead.
Yeah. And definitely still the tech sector continues to be my main focus. But yeah, I'll get into a chart real quick here
Okay.
shortly
All right, I'll
about
stop interrupting you with
well,
accolades.
that's
All right.
fine. I always enjoy
And
our
people don't
conversation,
mind
Dale.
those interruptions anyway, so
All
go ahead, bro.
right. So table selection is the biggest thing. You make a lot of stakes if you go and buy uh cocoa before it hit, whatever 10,000 or whatever the number is. If you bought whatever S&Ps at 2,000, you can make a lot of mistakes along the way as long as your table selection is good. Diversification helps because if you have more than one strategy instead of just like it's a breakout, watch it run, that's great if you have multiple markets you're looking at, or you need to look at a separate strategy and ideally both. And then of course, risk management is the thing that because we're going to be wrong quite a bit. So just making sure that when we are wrong, we do it the right way, and when we're right, we take advantage of it. So my best tweet to date was a tweet about Paul Tudor Jones. Basically, I took it from his interview in the Market Wizards book, and I'm sure plenty of everybody paying attention right now has read the Market Wizards books. But if you haven't, you should probably just go and buy them all and start going. And one thing that stood out to me the most about that first book was the most successful traders that came out of the 1970s, Paul Tudor Jones, Bruce Kovner, and these Marcus Sequoia, all these guys, is they were they were the young guys doing the stuff that the old guys were telling them that they were crazy to do, that they were a bunch of cowboys, that they were a bunch of wild men. They should like stop playing that game and go do, go buy
Tape read?
Ford. What's that?
Go back to tape reading?
Go back to tape rating. Play your bonds, son. Stop messing around with this crazy lumber and crude oil and
Oh, I see.
commodities.
They didn't even like the instruments they were trading.
That's right. And they
Okay.
made fun of them. You just, and it's pervasive in the stock market, and in like the 2000s and 1990s, 2000s, everybody was picking on people that are trading tech stocks. It just kind of, we're back there right now with the AI stuff. And so a great quote of his is, he's like, look, there's about 5 different ways to play the market to make money. 2 of those ways are mean reversion, which is a long short strategy. He says, or you can play momentum trend. And that's typically what I do. When something's cheap, they tend to get cheaper. Many times they get removed from an index and then they lose all hope. If something's going down, I want to be short it. If something's going up, they get added to the index, and that's kind of a self-fulfilling thing. So he's kind of really well known for his trend following and getting in and having a lot of losers. But when he has winners, he has really big winners. And that's a lot of what he talked about in that book. And that's the core foundation of what we're focusing on right now, which is, when things get going, we could look, NVIDIA is the second one here in this chart. The first one's Cocoa. And you can see that as we all have discovered for the last 30 years, NVIDIA came out of nowhere. Except if you built your own PC, you knew that NVIDIA chips were GPUs were or just video cards were like the best video cards 25 years ago. But had you fast forwarded to where they are today, nobody would have guessed it. But
did Paul Tudor Jones say that the big money is made at the turns?
He did say that as well. Yep.
Which isn't exactly trend following.
It's not exactly trend following.
And that's so, that's what I took away from him, that the big money is made at the turns. But then you ride the trend, of course. But
yeah,
no,
it's that's a good point. I'm not
I
personally.
catch the turns, and then I don't ride the trends as long as I can.
Well, and that's, you know, that's a good part of mean reversion. For what I did is I went out and I did a bunch of statistical research on this and
Yeah.
discovered, which is not anything new. You know, once you kind of figure out where you're going to fall into place, and then you say, okay, I'm good at just catching it when they get going, and then I actually have, and I'll get to it here in a second about how to stay in a trend a little bit better. But this is, you know, a really good example of a lot of people would have been taking cocoa off the table, and I don't have a chart, but you know, the last time it was this high was the 1970s, right?
Yeah.
Back in the 1970s, cocoa was this high, and of course, if you went up to the all-time highs, you were probably getting out of it. There's three phases to a trend, and those three phases are the actual early trend itself, which is this thing, as we can see kind of right here. I'll show it on Google. This is the early trend. And yes, it could be a cup and handle you could look at. You could see a lot of different things. But the trend is something that by the time it gets up to the top, most people don't believe the trend is actually intact. They think that's the end of the trend. And then it gets to this all-time high breakout level. And once that happens, that oftentimes sends it back down, right? If we were to, well, I guess looking left is not a good example, but you get your breakout, you get your retest, and then you're going to get a number of breakout retests along the way. It's definitely not a clean shot. But the actual big move happens in the momentum phase after it is trended so far, broken out, and then the momentum is where you get that's the parabolic curve that tends to happen. Yeah. And most people try to buy this. Yeah. Okay. They'll try to buy this. They get shaken out, or they buy this and it goes, and then, you know, the momentum phase goes further and lasts longer than most people can actually mentally picture. And if we, you know, that's exactly what happened to cocoa. You can barely kind of see how it broke out, and then it just keeps going. So
what's the
if
next
we add
cocoa? Silver?
That was cocoa. So let's go and add a little bit of crypto to the number. And we start seeing that cocoa's all the way down here, and crypto like Solana this goes back to October, by the way. So a little bit, this would have been the spot that cocoa took over that we were measuring against. But you can see the crypto, Dogecoin, Cocoa, Bitcoin, Nvidia, Ethereum, triple Qs are all kind of in that really big range that just started. You can see it's a bit of a trend. And then we add in something so we add in things like the dog with hat. Another, if you're confused about what Dogecoin does, you're really going to be confused about the fact that this is a meme coin of a picture of a dog with a hat on. And that has made 1,300% in that same period that Cocoa and everything else did it. And then these AI coins, if you look at those sort of things, like they don't actually really do AI yet, but they say they do AI. And since we're talking about an unregulated market, you can just kind of do that. Whereas some of those electric automakers in the public markets that are regulated are having a tough time with just saying they do things.
Yeah.
So I'm gonna kind of get this into a little bit more statistical side. So table selection is the best returning asset if we're looking at the NASDAQ, S&P, the dollar, Bitcoin by far, is that 13,000% in 10-year returns versus 174%. But, and you know, trend, thousands of years, but this is a 200-year chart of the trend. And, you know, if I go back and I show these three things, 47% compounded annual growth versus the NASDAQ, so that's like 3 or 4x the NASDAQ. And I mean, this is 1,000x, 10,000x, the S&P in 10-year period. It doesn't give the whole picture, but it says, you know what, if you could be in trend over the very long period of time, it's going to work. And so what we see is that crypto is that amazing opportunity. I won't read all this sort of stuff out, but one of the big reasons that keeps crypto and these, the reason why gold isn't doing the big move that cocoa's doing at the moment is because a lot of people are really prepared for the gold move. Nobody was prepared for cocoa. Nobody's really prepared for crypto in the way that they're prepared for a gold or a NASDAQ or an S&P type breakout. And so, here's a bunch of risks, scams, 24/7, 365, volatility. You can have a 50% flash crash. Meme coins are the cool thing. And then, of course, the drawdowns. This is a chart of Bitcoin's 70 to 80% drawdowns every couple of years versus a gentlemanly 31% drawdown in the COVID period. Right. So, of course, we all know that if the volatility is there, there's going to be opportunity, and that's the big thing. So, one of the things that I talked to, probably the most important part of this entire thing is the volatility, how you size your positions to play these things. If you knew that you had an opportunity to make like a 1,000 or a 5,000% gain, do you think you needed to put, $10,000 of your $10,000 account to work on that? Or could you put, much smaller and still get the returns? And that's the whole point of taming trend following. And that this is, it's called vol targeting. I don't want to I know I'm getting a little too into it, but the, one of the best trend following firms out there, ALH Man, uses this thing called vol targeting, where the higher the volatility, you lower your position size, and the lower the volatility, you have higher position size. It just kind of makes sense. And if we get back to that, if we get back to that, it's like your position sizes, like as prices rise going into this, your position sizes drop. And that's where the trend index underperforms buy and hold. Buy and hold makes you poop yourself during global financial crisis and things like that. But by using, if we look at the top line, you can see that the returns outperform and you maintain control of your bowels in that environment. Okay. So trend following and risk management, you're thinking to yourself, okay, of course I'm willing to, I know that I'm going to get my butt kicked if I go into these super high risk markets because it's just, not worth it. But I know the opportunity's there. So what I did is I ran the same algorithms on crypto and on futures. So it's long short trend of the data set that I could get. And again, this was the by going long short crypto versus what we were looking at, the returns end up being 58%. I didn't get that extra line in here. You can't see it, but 58% compounded. So in a 10-year period, your $100,000 in the NASDAQ makes about $500,000. In Bitcoin, it makes 6.9 million. And in this vol targeted position, that means adjusting for position size, going long and short, everything you need to do, it even blows away Bitcoin's old buy and hold. And it does it with only a 20% drawdown as opposed to Bitcoin's 80% drawdowns. And so this is what that looks like.
Is it an instrument you can trade? What is it?
Sorry, Pollinate Trading is the name of my company. That's the strategies we use. I should have said pollinatetrading.com on that. I want to get through it for you and not put your people to sleep before the market opens.
No, they're hanging around. Okay. Barry
so this said
you've caught my attention. Salum says this is a great interview. Thank you, guys.
Wonderful.
Yeah.
Barry, love you guys.
You feel the love?
All right, go. I love coming to chat with you all the time. This only goes back to 2020 because the data set of crypto is new. But it's been doing live trading and staying the same since January 2024. That's a 620% total return. But the compounded annual growth rate at 58%. with a 20% drawdown, max intraday drawdown. Yes, that is crazy. I get it. What we do is we do vol targeting, and basically for every dollar of risk, you make about $6 in return in crypto just since 2020. That includes the entire bear market of 2021, 2022, which you can see on the chart basically is this mild area of just mild spikes, and then we take off into the bull. So I went and did the same thing on 15 years of futures data, 15 years of about, I believe 10 or 15, because if it shouldn't just work in crypto. It should work in any market that trends, right? If you're going to have a trend, the trend system should work there. And this is a 15-year back test, so 50% better total returns, but the compounded annual growth rate is 38%, which is not is like 50% less than what you're getting the other one. The intraday drawdown is about the same, 21%. And no down year since 2010, 2009. Surprisingly, my data providers think that 2007 to 2009 is an important year to have in the data set when I ran it. Thank you, guys. Wonder what happened those years. But since 2008 or 2009, there hasn't been a single down year, and you maintain the exact same risk profile as trading crypto. So the idea, and this is all the profitability, you have let's see, what was a painful year? 2015 had a 7% return. 2020, 34% return. So not, if you're aware, this isn't too different than what you would have gotten, or this is a lot different than what you would have gotten if you just went like long S&P. So that's the summary here. And the point being is, if we just went long S&P, you're going to have major drawdowns and have a 12% CAGR, whereas if you have a vol targeted diversified, and we're only talking about 10 to 15 futures contracts there, you're making about 40% returns with the same 20% drawdown compounded.
Do you have a fund or a model account that reflects it?
I am I'm launching a fund. We're in the process right now of
cool. Congratulations.
Yeah. Thank you very much. Okay. It's
right.
En route.
All right, nice. Okay. You want to just cover this? And
yeah, I wanted to, as we were talking about last time I was on, was right over around this area in January, if I believe, somewhere right in there. And I think, it was January. Yeah. And that's where we went. Nice. You can see that the same pattern, trend, breakout, retest, breakout existed right there. So it's not really anything new. And the smiley faces are when we added to our position.
That formation gives you 6,000.
Yes, I believe it. Yeah, somewhere around there, a measured move, or, a Fibonacci type extension in that area is pretty warranted. So there's two things that are really, if we got enough time, I'll take a look at them. So this is the commitment of traders or large speculators. That's this down area right in here. And if we look back to, let's say, somewhere around the global financial crisis at the bottom and mass pessimism, we came out of that back in 2022's bottom, 2023's bottom. This is for the S&P 500, by the way. So large speculators are, generally speaking, for the last, let's call it 15 years, 10 to 15 years, we are positioned in the lowest area that we've been since global financial crisis. Peak was back in 2018, right after or right during Volpocalypse, for those of us that partook. So we have been, pretty much since that period, we have been in The most underpositioned large speculators since Volpocalypse, and then post-COVID, we're still way down here, regardless of everybody thinking that we are, too high, too fast, and all that sort of stuff. This is saying, as we all kind of know, a lot of people missed it and they're waiting for those pullbacks. And so one thing I monitor that keeps me in the game here is this is a 10-week average, 10-week simple moving average of the NYSE advancing issues. And I have the actual, that's the NYSE advancing issues. You can see that it's just sloppy and doesn't give you a whole lot of information. It's fast moving. But the 10-week moving average gives me a pretty good idea of where we are. When we get down into this area down in here, this is where I want to start seeing buyers or reasons to buy. And on the upside, it doesn't correlate nearly as well because markets go up, I guess. But I've found that anytime we get down into this little shadowed area on S&P, it isn't just an instant buy signal, though it very well could be. You have crash mode, which is when you get down to this, as you can see, the COVID one, we had crash mode in October of 2022. We got to crash mode, but we didn't actually crash, and that turned into the bottom. And so, as a lot of us know who've been in this game, crash mode, the only thing that happens in a crash is that the government steps in, intervenes, and saves the market, or we all die. And we haven't had an example of us all dying since the 1930s so far. So that's about where we are right now. So right now, I'm just keeping my eye open for a reason to start looking to get long. I just picked up Google on Friday as one because it is outperforming right now, and now we're giving it back a little bit, and that's fine. I'm no big deal. I'm not looking for a 5-point gain on it. I'm looking for the big money to kick in, and that's generally how I'm paying attention to the equity markets. And as goes the equity markets like this, it's going to affect crypto the same way. Pretty much risk markets are going to always perform, World War III notwithstanding.
Okay, so why don't you show the people where they could get a hold of you, follow you? I know they could follow you on X at Chris D Macro.
That's me.
Yep.
Yes. On X, go read the pinned thread from the Paul Tudor Jones here. At Chris D Macro right there. My website, pollinatetrading.com. We have a trading group, not to compete with F.A.C.E, of course, and a few trading systems that we've put together. You can get in and go around and find some articles, and I'm a wonderful follow, I think.
Okay, Chris is a pro. He works hard. You could tell he really puts in the time. You can't be lazy and be a good analyst trader. ... So thanks again, buddy, for coming in and edifying the community over the last few years. And
Yes, sir.
appreciate it. So good hunting, and always rooting for you, Chris.
Dale, I appreciate you, sir, always.
All right, Chris Dover, everybody. Check him out on X at Chris D Macro. And he writes prolifically on X. He puts a lot of good content out there. And check out his website. And that's going to be a wrap for Turnaround Tuesday, everybody. Join the team in 12 minutes on the Morning Edge, where you could see where all the great traders that hang out together, what their edge is. So don't just count your pips or your seasonals or your positions, count your blessings. And I'll see you tomorrow. Adios, Warriors. Thanks again, Chris.